Camarilla pivot points. Camarilla pivot points are a variation of the traditional pivot points used to identify potential support and resistance levels. Developed by Nick Stott, Camarilla pivot points are widely used by short-term traders to anticipate price movements and identify entry and exit points based on intraday market levels. How it works: Camarilla pivot points are calculated using the high, low, and close of the previous trading day. These points are then used to determine key levels, including support and resistance levels. The formula involves 8 key levels, the central pivot point, H4, and the 7 surrounding levels, S1, S2, R1, R2, R3, R4. Applications in trading: support and resistance. Camarilla pivot points help traders identify significant levels of support and resistance. These levels are especially useful in volatile markets and can guide entry and exit points. Breakout trading: if the price breaks above a key resistance level, R3 or R4, it may signal an upward breakout. Conversely, a break below key support levels, S3 or S4, may indicate a downward breakout. Risk management: traders can use the Camarilla levels to set stop-loss orders. The levels represent where the price is expected to reverse, providing a safeguard against large losses. Example: if a trader sees that the price is approaching the R3 level, they may consider entering a long position, anticipating a breakout. Conversely, if the price is approaching the S3 level, they might look to short the asset or exit a long position. Limitations: Camarilla pivot points are more effective in trending markets than in range-bound or choppy markets. These levels can sometimes be breached without the price reversing, resulting in false signals.